Before we dive in, a quick but important note. I am not a financial advisor, and this presentation is for educational and informational purposes only. The information provided is not a substitute for professional financial advice. Always consult with a qualified professional, like a licensed mortgage loan originator or financial planner, before making any major financial decisions. Your situation is unique, and you deserve personalized guidance. Alright, let's get into it. I will never forget the feeling of sitting in a small beige office, a stack of papers in front of me that looked thicker than a phone book. My palms were sweating. The loan officer, a perfectly nice guy, was throwing around a language I didn't understand. He was saying words like amortization, escrow, PMI, and points. I just sat there, nodding my head like I knew exactly what he was talking about, but inside my brain was screaming. I was terrified of looking stupid. I was about to sign on the dotted line for the single largest purchase of my entire life, a 30-year commitment, and I was basically flying blind. That feeling of being powerless and confused in the most important financial moment of your life. That is exactly why this video exists. Because here's the secret the real estate industry doesn't always advertise. You're not just buying a house. You're buying a mortgage. The house is the prize, but the mortgage is the game. And for the next 30 years, you will have a much more intimate relationship with your mortgage payment than you will with your granite countertops or your walk-in closet. Winning this game, getting the right mortgage, can save you $50,000, $100,000, even $200,000 over the life of your loan. Getting it wrong can cost you just as much. So my promise to you is this. By the end of this video series, you will not just understand the mortgage process. You will be in control of it. We are going to demystify the jargon, expose the hidden traps, and give you the exact questions to ask so you can walk into any lender's office with unshakable confidence. We're going to turn that feeling of fear into a feeling of power. So where do we begin? We start with the single most important question, the one that kicks off this entire journey. How much house can I actually afford? Notice I didn't say, how much can I get approved for? That's a different question, and confusing the two is the first and most expensive mistake that first-time homebuyers make. Getting a pre-approval from a bank is their calculation of the maximum risk they are willing to take on you. It's the absolute ceiling of what they will lend you. Your affordability, on the other hand, is what you can comfortably pay each month without becoming house poor, without having to eat ramen noodles for a decade just to keep the lights on. Think of it this way. A bank's pre-approval letter is like your car's speedometer. It might say your car can go 150 miles per hour, but if you drive 150 miles per hour through a school zone, you're going to end up in a world of trouble. Your personal budget, your actual affordability, that's the safe and responsible speed limit you set for yourself. The bank tells you what you can do. You need to tell yourself what you should do. So how do you figure that out? You start by ignoring the Zillow estimate and instead focus on the four letters that truly matter. PITI. Principal, interest, taxes, and insurance. This is your total monthly housing payment. Principal is the part of your payment that actually pays down the loan balance. In the beginning, it's a tiny sliver. Interest is the fee you pay the bank for the privilege of borrowing their money. In the beginning, this is the giant chunk of your payment. Taxes are your property taxes, paid to your local government. And insurance is your homeowner's insurance, which protects your house from, burning down. A great rule of thumb to start with is the 28 of 36 rule. It's a guideline lenders use, and it's a solid starting point for you too. The 28 means your total housing payment, your PITI, should not be more than 28% of your gross monthly income, which is your income before any taxes are taken out. The 36 means your total debt payments. That's your PITI plus your car payment, student loans, credit card payments, everything. Should not be more than 36% of your gross monthly income. Let's make that real. Say you and your partner make a combined $80,000 a year. Your gross monthly income is about $6,667. According to the 28% rule, your maximum PITI should be around $1,867 per month. That is your speed limit. A bank might approve you for a loan that pushes you to 35% or even 40%, especially if you have good credit. But just because you can, doesn't mean you should. Living at that limit leaves you with zero wiggle room for emergencies, for saving, for investing, or for just having a life. And PITI isn't even the whole picture. This is what trips people up. Your budget has to account for the hidden costs of homeownership. Things like utilities, your water, gas, and electric bills will likely be much higher than in an apartment. Maintenance. Experts say you should budget 1% of your home's value every single year for repairs. For a $400,000 house, that's $4,000 a year, or over $330 a month you need to be saving. And don't forget HOA fees or homeowners association fees, which can add hundreds of dollars to your monthly costs for things like community pools or lawn care. The bank's pre-approval doesn't care about your light bill or the fact that your water heater might explode. You have to. So, build your own budget first based on pity plus these extra costs, and find a monthly payment that feels comfortable, not terrifying. That number, the one you choose, is how much house you can actually afford. Okay, so you've done the hard work. You've built a realistic budget. You know your personal speed limit. Now what? How do you go from a number on a spreadsheet to a powerful tool that makes real estate agents take you seriously and sellers see you as a legitimate buyer? This brings us to the next critical step, and the two most confused terms in the entire process: pre-qualification versus pre-approval. They sound almost identical, but in the real world they are worlds apart. Pre-qualification is a guess. It's a 10-minute phone call where you tell a lender your income, you tell them your debts, and based on that unverified, self-reported information, they give you a rough estimate of what you might be able to borrow. It's not worth the paper it's printed on. Pre-approval is proof. This is where you actually apply for a loan. You provide the lender with your pay stubs, your W-2s, your bank statements, your tax returns. They pull your credit report. They do a deep dive into your financial life, and after all that verification, they issue a conditional commitment to lend you a specific amount of money. Let me give you an analogy. A pre-qualification is like telling a football coach you're a really fast runner. A pre-approval is like showing him your official time from a certified track meet. One is a claim, the other is evidence. In today's competitive housing market, showing up with only a pre-qualification is like showing up to a gunfight with a water pistol. Sellers won't even look at your offer. They want to see that a lender has already vetted you and is ready to write the check. A pre-approval letter transforms you from a window shopper into a serious contender. It gives you the power to negotiate and the confidence to make a firm offer when you find the right home. Getting that pre-approval letter is a huge milestone. It's the moment this all starts to feel real. But that letter also opens up a Pandora's box of new, critical questions. What kind of loan should you actually get? A 30-year fixed rate? A 15-year? What about an FHA loan, a VA loan, or a USDA loan? The type of mortgage you choose is one of the biggest forks in the road on this journey. And it can change your monthly payment by hundreds of dollars and your total cost over 30 years by over $100,000. It's a decision that echoes for decades. So let's walk down that road. The first path you'll see, the one that's wide, well-paved, and has the most people on it, is the 30-year fixed-rate mortgage. This is the absolute titan of the mortgage world. It's the default, the one you hear about most often, and for good reason. The magic is in those two words: fixed rate. It means that the interest rate you lock in on day one is the exact same interest rate you will have on day 10,950. Your monthly payment for principal and interest will never ever change. If your payment is $2,000 in your first year, it will be $2,000 in your 30th year, even if market interest rates have skyrocketed to 20%. This predictability is its superpower. It's a security blanket in a chaotic economic world. You can budget your entire financial life around this one unwavering number. For a first-time homebuyer, this stability is priceless. It removes one of the biggest variables from your life for the next 3 decades. The other major advantage is that it offers the lowest monthly payment of any fixed-rate loan. Because you're stretching the debt over a massive 360 payments, each individual payment is smaller and more manageable. This often means you can qualify for a more expensive house than you could with a shorter-term loan. More buying power and total predictability. Sounds perfect, right? Well, here's the dark side of that 30-year journey. It's a very, very expensive trip. Because the bank is taking on the risk of lending you money for such a long time, and guaranteeing your rate won't change, they charge you a higher interest rate than on a shorter loan. And over 30 years, that slightly higher rate becomes a monster. Let's use some real numbers. Imagine you get a $400,000 loan. With a 30-year fixed mortgage at a 6.5% interest rate, your monthly principal and interest payment would be about $2,528. Now listen closely. Over those 30 years, you will pay the bank back your $400,000 plus an additional $510,000 in interest alone. You will pay more in interest than the original loan amount. You're essentially buying your house almost 1.5 times over. That's the staggering price of that low monthly payment and long-term stability. Now let's look at the second path right next to the first. It looks deeper, more challenging. This is the 15-year fixed-rate mortgage. It's exactly what it sounds like, same loan, but you pay it off in half the time. The rate is also fixed, so you still get that amazing predictability. But everything else is different. Because the loan is for a shorter term, the bank's risk is lower. So, they reward you with a lower interest rate, often 0.5% to a full percent lower than the 30-year rate. That doesn't sound like much, but it's a huge deal. The real trade-off, and the reason this path is less traveled, is the monthly payment. It's significantly higher. You're cramming 30 years of payments into 15. Let's go back to our $400,000 loan. With a 15-year mortgage at a lower 5.75% interest rate, your monthly payment would jump to around $3,323. That's nearly $800 more per month than the 30-year option. For many first-time buyers, that extra $800 is a deal-breaker. It's the difference between affording the house and not. It's a much heavier lift every single month. So why would anyone choose this more painful option? Because of the destination. While the 30-year borrower is still slogging away in year 16, the 15-year borrower is completely debt-free. They own their home free and clear. But that's not even the best part. Let's look at the total interest. With that higher payment and lower rate, over 15 years you pay back your $400,000 plus about $198,000 in interest. Let that sink in. The 30-year borrower paid over $500,000 in interest. The 15-year borrower paid less than $200,000. By choosing the steeper path, you would save over $312,000. $312,000. That's a college education for 2 kids. It's a fleet of new cars. It's a life-changing amount of money that you get to keep, simply by choosing a different loan structure. You also build equity, which is the part of the house you actually own, at lightning speed. In the first few years of a 30-year mortgage, your payments are almost all interest. You're barely chipping away at the loan itself. With a 15-year, a huge chunk of every single payment goes directly to your principal, building your net worth from day one. So the choice between these two is a fundamental question about your financial priorities. Do you want lower monthly payments and more cash flow right now, at the cost of paying a fortune in long-term interest? That's the 30-year. Or can you handle a much higher monthly payment in exchange for becoming debt-free decades earlier and saving a truly staggering amount of money? That's the 15-year. There's no single right answer. It's about what fits your life and your discipline. But what if there was a third door? A loan that seems to offer the best of both worlds? A monthly payment that's even lower than the 30-year fixed, at least at first. This is the siren song of the adjustable rate mortgage, or ARM. And this is where things get complicated and frankly a little dangerous if you don't know what you're doing. An ARM is a hybrid. It starts with a fixed interest rate for a set period, usually 3, 5, 7, or 10 years. This initial rate, the teaser rate, is typically the lowest rate you can find anywhere. It makes the initial monthly payments incredibly attractive. You might see it written as a 5-1 ARM or a 7-1 ARM. The first number tells you how many years the initial low rate is fixed. The second number tells you how often the rate can change after that initial period is over. So a 5-1 ARM has a fixed rate for the first 5 years, and then it can adjust every 1 year after that for the remaining 25 years of the loan. And when it adjusts based on a specific market index, plus a margin set by the bank. This means your interest rate and your monthly payment is no longer predictable. Could go up, could go down. But historically, the risk is that it goes up, sometimes dramatically. After that initial fixed period, you are essentially gambling on what interest rates will do in the future. If rates have fallen, your payment might go down. But if rates have risen, your payment could jump by hundreds, or even over $1,000 overnight. The loan documents will have caps that limit how much the rate can increase in 1 year and over the life of the loan, but those caps are often set very high. You could go from a comfortable 3.5% introductory rate to a punishing 8.5% over just a few years. It's the financial equivalent of a ticking time bomb, and it's what caused millions of people to lose their homes in the 2008 housing crisis. So given that terrifying risk, who on earth would ever choose an ARM? Sounds like financial suicide. Well, it's not for most first-time buyers who plan to stay in their home for a long time. But for a very specific type of buyer with a very specific plan, it can be a powerful strategic tool. The key is understanding why they're taking that risk, and what their escape plan is before that bomb ever has a chance to go off. So who is that person? Who is the ideal candidate for an adjustable rate mortgage? It might be a medical resident who knows they have a seven-figure attending salary just 3 years away. They can handle a potential rate jump because their income is about to explode. Or maybe it's a house flipper who knows with 100% certainty they'll be selling the property in 18 months, long before the first adjustment hits. They're not betting on the future. They're executing a short-term plan where the lower initial rate gives them more capital to work with. They have an exit strategy baked in from day one. For everyone else, the stability and predictability of a fixed-rate mortgage is almost always the safer, smarter path. It lets you sleep at night. And that brings us to the single biggest question that dominates the entire home buying process. The number one thing that keeps people up at night. The interest rate. What is it, where does it come from, and why is your rate different from your friends who just bought a house last month? This is where most people get it wrong. They think the interest rate is just a number a bank slaps on a loan. A price tag. But it's not. Your interest rate is a story. It's the story of you, told in the language of financial risk. When you apply for a mortgage, the lender becomes a detective. They open up your financial case file, and their one and only job is to answer a single question. How likely is it that we will get our money back on time every time for the next 30 years? Your interest rate is their final answer to that question. A lower rate means they read your story and thought, this is a sure thing. A higher rate means they saw a few plot twists that made them nervous. So what are the chapters in your story they're reading so closely? First and most famously is your credit score. This is the protagonist of your financial story. It's a 3-digit number that summarizes your entire history of borrowing and repaying money. Think of it like this. A credit score isn't just a grade. It's a measure of your promises. Have you kept the promises you made to credit card companies, auto lenders, and student loan providers? A score of 760 or higher tells the lender that you are a person of your financial word. You have a long documented history of making payments on time. To them, you're not just a person, you're a blue-chip investment. You're reliable. A score below, say 640, tells a different story. It suggests there have been missed payments, defaults, or other stumbles. It doesn't mean you're a bad person, but to a lender, it means your story has more risk. They might still give you the loan, but they'll charge you a higher interest rate to compensate for that extra risk they're taking on. It's their insurance policy against the uncertainty in your story. The next chapter they read is your down payment. This is the chapter about skin in the game. Imagine two buyers for the same $400,000 house. Buyer A puts down 3%, which is $12,000. Buyer B puts down 20%, which is $80,000. Who do you think the lender sees as a safer bet? It's buyer B, and it's not just because they're borrowing less money. It's about psychology. Buyer B has $80,000 of their own hard-earned cash tied up in that property. If the housing market takes a dip and the home's value drops, they are far less likely to just walk away and let the bank foreclose. They have too much to lose. Buyer A, with only $12,000 invested, has a much smaller anchor holding them to the property if things go south. A bigger down payment is a powerful statement. It says, I am committed to this. I am financially stable. And I am sharing the risk with you. And this is precisely why lenders reward a down payment of 20% or more by removing the requirement for private mortgage insurance, or PMI. PMI is an extra monthly fee you pay that doesn't go towards your loan balance or build your equity. It's an insurance policy that protects the lender, not you in case you default. By putting down 20%, you are effectively telling the lender, you don't need to buy that extra insurance policy on me. My down payment is your insurance. Escaping PMI can save you hundreds of dollars every single month, which is a massive win. Next, the lender flips to the chapter on your debt-to-income ratio, or DTI. This is the math portion of your story. It's a simple but brutal calculation. They add up all your monthly debt payments, car loan, student loans, credit card minimums, and then add your proposed new mortgage payment. Then they divide that total by your gross monthly income. The resulting percentage tells them how much of your paycheck is already spoken for before you even buy groceries. Imagine your monthly income is a bucket. Every debt you have is a rock you've already put in that bucket. The lender is holding a big new rock, the mortgage, and they're looking at your bucket to see if it'll fit without overflowing. Generally, lenders want to see your DTI, with the new mortgage included, be below 43%. Some programs are more flexible, but that's a solid benchmark. If your DTI is, say, 50%, it means half of your gross income is going straight to debt payments. That's a heavy bucket. It doesn't leave much room for emergencies, like a job loss or a major medical bill. To a lender, a high DTI is a flashing red light. It's a story about living too close to the edge, and it will almost certainly lead to a higher interest rate if you're even approved at all. Finally, there are factors that are less about your personal story and more about the world around you. The type of loan you choose matters. A 15-year fixed mortgage will typically have a lower rate than a 30-year, because the bank gets its money back twice as fast, cutting their long-term risk. And then there's the biggest character of all, the economy. The Federal Reserve's policies, inflation rates, the bond market. These things create the weather system in which all loans exist. You can't control the economic weather. All you can do is make your own financial boat, your credit score, your down payment, your DTI, as strong and seaworthy as possible. So you've done all that. Your story is solid. The lender comes back with an offer. Let's say it's 6.5%. But then they say something interesting. You know, for about $4,000, we could get that rate down to 6.25%. What they're offering you is the chance to buy down your rate by paying points. This is one of the most confusing parts of the mortgage process, but the concept is simple. A point is just a fee you can pay up front to get a lower interest rate for the life of the loan. 1 point costs 1% of your total loan amount. So on a $400,000 loan, 1 point would cost you $4,000. In exchange for that $4,000 fee, the lender might lower your rate by, for example, 0.25%. Is this a good deal? It's not a yes or no question. It's a math problem. You have to calculate your break-even point. Let's stick with that $400,000 loan. A rate of 6.5% gives you a monthly principal and interest payment of about $2,528. A rate of 6.25% gives you a payment of about $2,462. That's a savings of $66 per month. Now, you paid $4,000 upfront to get that $66 monthly savings. To find your break-even point, you divide the cost of the points by your monthly savings. So, $4,000 divided by $66 is roughly 60. That means it will take you 60 months or exactly 5 years just to earn back the fee you paid. This makes the decision crystal clear. The only question you need to ask yourself is, am I going to be in this house with this specific mortgage for longer than 5 years? If the answer is a confident yes, then paying the points is a fantastic deal. For every month you stay past the 5-year mark, you're putting pure profit, that $66, back in your pocket. But if you think you might move, or if you plan to refinance as soon as rates drop in a couple of years, then paying those points is like setting $4,000 on fire. You'd be paying for a discount you'll never get to fully use. Understanding your interest rate isn't about finding a magic number. It's about understanding the story your finances tell, and then making a strategic decision about whether to pay now, in the form of points, or pay more over time with a higher rate. But your interest rate and points are just the tip of the iceberg. There's a whole hidden world of fees and charges waiting for you at the closing table, and some of them are negotiable, if you know what to ask for. We call them closing costs, and they can add thousands, even tens of thousands, to the price of your home. So what exactly are you paying for? Let's break down this mountain of fees into 3 simple buckets. First, you have the lender fees. These are the charges your bank or mortgage company bills you for the service of creating your loan. Second, there are third-party fees. These are costs for services performed by other companies that are required to get your loan to the finish line. And third, you have prepaids and escrow. This one's a bit different. It's not really a fee, but more like you pre-funding a special savings account for your future property taxes and homeowners insurance. It's your money just held by the lender. Let's start with bucket number 1, lender fees. This is where you have the most power, the most room to negotiate. Think of this as the lender's salary for putting your entire deal together. The biggest fee you'll see here is usually the loan origination fee. This is a catch-all charge for processing your application and underwriting the loan. It's often calculated as a percentage of the total loan amount, typically around 1%. So on a $300,000 loan, that's a $3,000 fee right there. You might also see separate line items like an underwriting fee, a processing fee, or an application fee. Here's the secret. These are all just different names for the same thing, paying the lender to do their job. And because it's their fee, it's often negotiable. When you're shopping for a mortgage, you can ask lenders if they can reduce or even waive some of these fees to win your business. A competing offer from another lender is your best leverage. Now, inside this same bucket, you might see something called discount points. This is one of the most misunderstood costs in the entire process. A discount point is a fee you choose to pay up front to get a lower interest rate for the entire life of the loan. 1 point typically costs 1% of your loan amount and might lower your rate by, say, 0.25%. It's essentially prepaying interest. Is it worth it? It's a math problem. You have to calculate your break-even point. How many months you'll need to stay in the house for the monthly savings from the lower interest rate to add up and cover the upfront cost of the points. If you plan to live there for a long time, it can save you a fortune. If you think you might move or refinance in just a few years, it's often a waste of money. The key is that it's optional. Don't let anyone tell you it's required. Okay, let's move to bucket number 2, third-party fees. These are the costs for services that the lender doesn't perform themselves, but are mandatory. Think of the lender as a general contractor building your loan. They have to hire subcontractors, and you have to pay their invoices. Because this money isn't going to the lender, these fees are almost never negotiable. The first big one is the appraisal fee. Before a bank lends you hundreds of thousands of dollars, they want independent proof that the house is actually worth that much. So they hire a licensed appraiser to inspect the property, compare it to similar homes that recently sold in the area, and issue a professional opinion of its value. You pay for this service, usually somewhere between $400 and $700. Another one is the credit report fee. The lender needs to pull your credit history and scores from the 3 major bureaus, and they pass that small cost, usually under $50, on to you. But the real heavyweight in this category is title services. This is a huge, confusing, and expensive chunk of your closing costs, but it's arguably the most important protection you'll buy. When you buy a car, you get a single, simple title. A house is different. Over decades or even centuries, it's had multiple owners, liens, easements, and heirs. The title could be a mess. A title search is like hiring a private investigator to dig through every public record, every dusty file in the county courthouse, to make sure the person selling you the house is the true owner and that nobody else, not a long-lost cousin, not the IRS, not a contractor who never got paid for building the deck, has a legal claim to your property. After the search, you'll buy 2 title insurance policies. Yes, 2. The lender's title insurance protects the bank's investment in your property. This one is mandatory. The owner's title insurance protects you, the new homeowner. It's a one-time premium paid at closing, and it protects your down payment and your equity for as long as you own the home. If some forgotten heir from 100 years ago suddenly appears with a valid will saying they own your living room, your owner's title policy is what keeps you from losing everything. While the cost for the policy is set by the state or the title company, you absolutely have the right to shop around for which title company you use. Your lender or real estate agent will recommend one, but you're not required to use them. A few phone calls could save you hundreds of dollars on the administrative fees they charge. Finally, we get to bucket number 3, prepaids and escrow. This is the part that feels like a fee, but it isn't. This is your money being set aside for future expenses. First are the prepaids. You'll have to pay for your first full year of homeowner's insurance upfront at closing. You'll also have to prepay the mortgage interest that will accumulate between your closing date and the end of the month. Then there's the big one, funding your escrow account. An escrow account is like a savings account that your mortgage lender manages for you. Every month, your total mortgage payment will actually be made up of 4 things: principal, interest, taxes, and insurance. We call it PITI. The principal and interest go to the lender to pay down your loan. The taxes and insurance portions go into your escrow account. The lender then uses the money in that account to pay your property tax bills and homeowners' insurance premiums on your behalf when they're due. It's a system designed to protect the lender. It ensures the taxes and insurance always get paid, but it also helps you budget, so you're not hit with a massive $5,000 property tax bill once a year. At closing, the lender needs you to pre-fund this account with a cushion, usually a few months' worth of taxes and insurance payments, so there's always enough cash in there to cover the bills. Again, this isn't a fee. It's your money going into your savings account. So how do you keep track of all this? How do you make sure you're not being overcharged? You have 2 secret weapons: the loan estimate and the closing disclosure. Within 3 days of applying for a mortgage, the lender is legally required to give you a standardized 3-page document called the loan estimate. This is their best guess in black and white of what your closing costs will be. It's the quote. You can use this document to compare offers from different lenders apples to apples. Then, at least 3 business days before your closing date, you will receive a second, very similar looking 5-page document called the closing disclosure. This is the final bill. Your job is to sit down with these two documents, side by side, and compare them line by line. Most of the numbers should be identical or very close. By law, some fees, like the lender's origination fee, cannot increase at all from the estimate to the final disclosure. Other fees can only increase by a certain percentage. If you see a new unexpected fee, or a fee that has jumped up significantly, you have the right, and the time, to pick up the phone and demand an explanation from your loan officer. That 3-day review period is your power. It's your federally mandated time to call foul before you sign on the dotted line. Mastering these documents, understanding these 3 buckets of costs, is what separates a savvy homebuyer from someone who walks into closing blind. You're not just paying a bill. You're verifying every charge, questioning every fee, and taking control of the single biggest financial transaction of your life. But even with the perfect loan and the lowest fees, there's one number that dictates your financial reality for the next 30 years more than anything else: the interest rate. So how is that rate actually determined? Is it just a random number based on your credit score? Or are there hidden factors and secret strategies you can use to secure the absolute lowest rate possible? The truth is, your mortgage rate is a cocktail, a complex mix of ingredients, some of which are completely out of your control, and others that you have absolute power to change. Let's start with the big ones, the global forces that set the stage for every single mortgage rate in the country. Think of these as the weather. You can't change the fact that it's raining, but you can decide to bring an umbrella. First, you have the overall health of the US economy and, believe it or not, the global economy. When the economy is booming, demand for money goes up and rates tend to rise. When it's in a slump, demand falls and rates often drop to encourage borrowing and spending. The most powerful player in this arena is the Federal Reserve, or the Federal. The Fed sets something called the federal funds rate, which is the interest rate banks charge each other for overnight loans. Now, the Fed doesn't directly set mortgage rates, but its decisions create a powerful ripple effect. Think of the Fed's rate as the main water valve for the entire financial system. When they turn it up, the pressure increases everywhere, and mortgage rates rise. When they turn it down, the pressure eases and mortgage rates tend to fall. The second major ingredient, and perhaps the most direct indicator for mortgage rates, is the yield on the 10-year Treasury note. This sounds complicated, but the concept is simple. A Treasury note is basically a loan you give to the US government. The yield is the return you get on that loan. Because lending to the US government is considered one of the safest investments on planet Earth, the 10-year Treasury yield serves as a benchmark for all other long-term loans, including 30-year mortgages. If investors are demanding a 4% return to lend money to the super safe government for 10 years, a mortgage lender is certainly going to demand more than that to lend money to an individual for 30 years. So if you ever want a sneak peek at where mortgage rates might be heading, watch the 10-year Treasury yield. When it goes up, mortgage rates almost always follow. And the third big picture factor is inflation. Inflation is the rate at which money loses its value. If inflation is at 5%, that means the $100 in your wallet will only buy you $95 worth of stuff next year. Lenders are terrified of inflation. Why? Because they are lending you a huge chunk of money today, and you're paying it back with future dollars that are worth less. To protect themselves, they have to charge an interest rate that is significantly higher than the rate of inflation just to make a real profit. So when you hear news about high inflation, you can bet that mortgage rates are feeling upward pressure. Those are the macroeconomic forces, the weather you can't control. But that's only half the story. The other half is all about you. This is where you get to take the wheel. Your personal financial picture is what a lender scrutinizes to determine how much risk you represent. The lower the risk, the lower the rate they'll offer you. The undisputed king of your financial picture is your credit score. This 3-digit number is a summary of your entire history of borrowing and repaying money. To a lender, it's a grade on your financial responsibility. A score of 760 or higher is considered excellent. It tells the lender you are an extremely reliable borrower, a very low risk. And for that, you get rewarded with the best possible interest rates. A score between 700 and 759 is still very good, and you'll get competitive rates. But once you dip below 700, and especially below 660, lenders start to get nervous. Each tier you drop down can cost you 0.25%, 0.5%, or even more on your interest rate. Over 30 years, that tiny difference can add up to tens of thousands of dollars in extra interest payments. Next up is your down payment, or more specifically, your loan-to-value ratio, or LTV. This is just a fancy way of saying how much of the home's price you're borrowing. If you buy a $400,000 house with a $40,000 down payment, you're borrowing $360,000. Your LTV is 90%. If you put down $80,000, your LTV is 80%. From the lender's perspective, a lower LTV is always better. A bigger down payment means you have more skin in the game. You're less likely to walk away from the loan if times get tough. And if you do default, the bank has a much larger equity cushion to protect them from losing money when they sell the house. A larger down payment, especially getting to that 20% mark to avoid PMI, directly reduces the lender's risk, and they will often reward you with a lower interest rate. Then there's your debt-to-income ratio, or DTI. This is a measure of your monthly debt obligations, car payments, student loans, credit card minimums, compared to your gross monthly income. A high DTI tells a lender that your paycheck is already stretched thin. Adding a big mortgage payment on top of that could be the straw that breaks the camel's back. Lenders want to see that you have plenty of breathing room in your budget. A lower DTI makes you a much safer bet, and a safer bet qualifies for a better rate. The type of loan you choose also has a massive impact. A 15-year fixed-rate mortgage will almost always have a significantly lower interest rate than a 30-year fixed-rate mortgage. Why? Because the lender gets their money back twice as fast, which dramatically reduces their long-term risk from things like inflation and market changes. Adjustable-rate mortgages, or ARMs, often start with a very low teaser rate for the first few years, but then they can adjust based on the market, which is a big gamble. Finally, even the property itself matters. A standard, single-family home is the easiest and safest property type for a lender to finance, so it typically gets the best rates. A condo, a multi-unit property, or a manufactured home can sometimes come with slightly higher interest rates because they are considered to have a little more risk. So, knowing all this, what are the secret strategies? How do you play the game to win? First, and this is the most important advice you will ever get, you must shop around. Do not, under any circumstances, just go to your personal bank and accept the first rate they offer you. Getting a mortgage is not like buying a gallon of milk where the price is basically the same everywhere. Rates can vary dramatically from one lender to another, even on the same day for the same person. Why? Because each lender has a different appetite for risk, different overhead costs, and a different profit margin they bake into their rates. You should get official loan estimates from at least 3 to 4 different lenders: a big national bank, a local credit union, and an independent mortgage broker. The loan estimate is a standardized government form, which means it's designed for you to easily compare offers apples to apples. This single act of shopping around is the #1 way to save thousands of dollars over the life of your loan. Second, understand rate locks. When you find a rate you like, you need to lock it in. An interest rate lock is a guarantee from the lender that they will honor that specific rate for a set period, usually 30 to 60 days, while your loan is being processed. In a market where rates are rising, a rate lock is your shield. It protects you from having your rate jump up right before you close. Be sure to ask how long the lock period is, and if there's any cost associated with it. And third, the ultimate pro move: understanding discount points. A discount point is a fee you can choose to pay up front at closing in exchange for a lower interest rate for the entire life of the loan. 1 point typically costs 1% of the total loan amount. So on a $300,000 loan, 1 point would cost you $3,000. In exchange, the lender might reduce your rate by, say, 0.25%. Is this a good deal? You have to do the math. Let's say that 0.25% rate reduction saves you $50 on your monthly payment. You paid $3,000 upfront to save $50 a month. To find your break-even point, you divide the costs by the monthly savings. $3,000 divided by $50 is $60. That means it will take you 60 months or 5 years to break even on that investment. If you plan on staying in the house for longer than 5 years, then buying that point is a fantastic financial decision. You're essentially prepaying interest at a discount. If you think you might sell or refinance in just a few years, then it's probably not worth it. So you've battled the market, polished your credit, and negotiated like a pro to lock in a fantastic rate. You're feeling victorious. But then a document arrives, the closing disclosure. And it's a terrifying wall of numbers and line items with names like origination fees, underwriting costs, title insurance, and escrow prepayments. What in the world are all these charges, and are you being ripped off? How can you tell which fees are legitimate and which are just lender junk fees designed to pad their profits? Let's break down this wall of text on your closing cost estimate, because understanding it is the single best way to save thousands of dollars. Think of all those fees not as one giant scary bill, but as 3 distinct buckets. Bucket 1: third-party fees. Bucket 2, lender fees. And Bucket 3, prepaids and escrow. Once you know which fee goes in which bucket, you'll instantly know what's legitimate, what's negotiable, and what's pure junk. Let's start with the first bucket, third-party fees. These are costs for services provided by people other than your lender, but they are required to get the loan. For the most part, these are not negotiable with your lender because your lender is just passing the bill along to you. The first one you'll see is the appraisal fee. This is what you pay a licensed appraiser to officially determine the market value of the home. Your lender requires this to make sure they aren't lending you $400,000 for a house that's only worth $300,000. Protects them, but it also protects you from overpaying. Expect this to be anywhere from $400 to $800, sometimes more depending on the property. Next is the credit report fee. This one's small, usually $20 to $50. It's the cost for the lender to pull your credit history and scores from the 3 major bureaus. It's a necessary evil. Then you have the big one in this category, title insurance. This is probably the most misunderstood closing cost of all. You'll see charges for a title search, lender's title insurance, and maybe owner's title insurance. What is this? Imagine you buy a house, move in, and 6 months later a long-lost cousin of the seller shows up, claiming they actually inherited a 50% stake in the house years ago and never approved the sale. Without title insurance, you are in a world of legal and financial pain. The title company does a deep dive into the property's history, the title search, to make sure the seller has the free and clear right to sell it to you. The lender's title insurance, which is mandatory, protects the lender's investment against any of these past claims. The owner's title insurance, which is technically optional but something you should almost never decline, protects your investment, your down payment, and your equity. It's a one-time fee paid at closing that protects you for as long as you own the home. Don't skip it. Finally, in this third-party bucket you have government fees. These are as non-negotiable as it gets. You'll see recording fees, which is what your local county charges to officially record the sale and put your name on the deed, and you might see transfer taxes, which is the tax levied by your state, county, or city on the transfer of property. Your lender has zero control over these. Okay, now for the second bucket, the one where you can make a real difference, lender fees. This is where the lender makes their money, and it's where junk fees love to hide. The biggest, most legitimate fee here is the origination fee. This is the lender's primary charge for the work of creating, processing, and funding your loan. Think of it as their main service charge. It's often expressed as a percentage of the loan amount, typically around 1%. So on a $300,000 loan, a 1% origination fee would be $3,000. This is a standard, legitimate cost of doing business. Next, you might see something called discount points or just points. This is one of the most powerful tools you have for customizing your loan, but you have to understand it. 1 point costs 1% of your loan amount. In return for paying this cost upfront at closing, the lender gives you a lower interest rate for the entire life of the loan. You are essentially prepaying interest to get a permanent rate reduction. Is it worth it? You have to do the math. Let's say paying $3,000 on that $300,000 loan lowers your monthly payment by $75. To find your break-even point, you divide the cost, $3,000, by the monthly savings, $75. The answer is 40. It will take you 40 months or about 3.5 years to recoup the cost of that point. If you plan on being in that house and keeping that loan for longer than 3.5 years, buying the point is a fantastic deal. If you think you might sell or refinance before then, you'll lose money. It's your choice. Now we get to the murky stuff. You'll also see other lender fees like an underwriting fee, processing fee, or application fee. The underwriting fee is the charge for the salaried underwriter to comb through your financial life and give the final approval. This is a legitimate part of the process, but this is where we start to tiptoe into the territory of junk fees. What is a junk fee? A junk fee is a made-up charge that a lender slips in to increase their profit. It's a fee for something that should already be covered by the main origination fee. It's pure padding. Think of it like this: you go to a restaurant and the menu says a burger is $15. But when the bill comes, there's a $2 chef fee, a $1 grill usage fee, and a 50-cent plate rental fee. You'd be furious, right? The cost of the chef and the grill should be included in the price of the burger. It's the same with a mortgage. The cost of processing paperwork and administering the loan should be covered by the origination fee. So how do you spot them? Look for words like processing, administration, document prep, or application. If you see both an origination fee and a separate processing fee, you should raise an eyebrow. If you see a $500 loan administration fee, you should ask what that is for specifically. That isn't covered by the $3,000 origination fee. A document preparation fee? In 2024, when most things are automated, that's a classic junk fee. A courier fee to send documents? Suspect. Here is your secret weapon: the loan estimate. By law, any lender you apply with must send you a standardized 3-page loan estimate form within 3 business days. Your single most important task is to get loan estimates from at least 3 different lenders. Then you sit down and compare them line by line. Pay special attention to Section A, origination charges. This is where the lender fees live. Lender A might charge a $3,000 origination fee, and that's it. Lender B might charge a $2,000 origination fee, but then adds a $500 processing fee and a $400 underwriting fee. Lender C might have no origination fee, but charges you 2 discount points and a $1,500 administration fee. By comparing them side by side, the junk fees become obvious. You can then go back to the lender you like best and say, "I have another offer here that doesn't include a document prep fee. Can you waive that to match the other offer?" Don't be shy. This is a business transaction, and those fees are often negotiable. They want your business. Make them earn it. Finally, we have the third bucket: prepaids and escrow. This is a critical point of confusion. This money is not a fee. This is your money that you are prepaying for future expenses. You'll see a charge for prepaid interest. This covers the interest on your loan from the day you close until the first of the next month. Your first official mortgage payment isn't due until the first of the month after your closing month. So if you close on May 15th, your first payment isn't until July 1st. The lender needs to collect the interest for the last 16 days of May, and they do it at closing. Then you have your escrow prepayments. If your loan has an escrow account, which most do, it's like a savings account managed by your lender. Every month, part of your mortgage payment goes into this account to cover your property taxes and your homeowner's insurance when they come due. To kickstart this account, the lender needs to collect a cushion at closing. They'll typically collect enough to pay for your first year's homeowner's insurance policy upfront, plus 2 or 3 extra months of insurance payments and a few months of property tax payments. Again, this isn't a fee. It's you putting your own money into a savings account, so the lender can pay these critical bills on your behalf. So to recap, third-party fees like appraisal and title are legitimate but mostly fixed. Lender fees in Section A are where you hunt for junk fees and negotiate. And prepaids are just you setting aside your own money for taxes and insurance. By breaking it down this way, that confusing list of charges becomes a clear roadmap. You can confidently ask, "Why am I being charged this processing fee? And can you waive this administration charge?" You are now in control of the process. So you've navigated the jungle of closing costs, you've fought off the junk fees. But then you see another mysterious charge that could cost you hundreds of dollars every single month. It's called PMI. What is this mortgage insurance? Why are you forced to pay it? And most importantly, what's the secret to getting rid of it as fast as humanly possible? This insurance isn't for you. Let me say that again because it's one of the most misunderstood parts of getting a mortgage. Private mortgage insurance, or PMI, does not protect you if you lose your job and can't make a payment. It doesn't protect your family. It protects the bank. It is an insurance policy that you are forced to pay for that benefits your lender. And the reason why is simple. From the lender's perspective, you're a risk. See, for decades, the gold standard for buying a home was putting down 20% of the purchase price in cash. A $20,000 down payment on a $100,000 home. $100,000 on a $500,000 home. When you have that much of your own money invested, that much skin in the game, the bank sees you as a safe bet. You are highly motivated to never miss a payment because you don't want to lose that massive chunk of your own cash. But what if you don't have 20%? What if you have 10% or 5% or even just 3% to put down? For millions of Americans, saving up a 20% down payment is the single biggest barrier to homeownership. So the mortgage industry created a solution. PMI. It's a deal. The bank says, "Okay, we'll give you the loan with a smaller down payment, but because you have less of your own money on the line, you're statistically more likely to default if times get tough. So to offset our increased risk, you have to pay for an insurance policy that will reimburse us if you stop paying and we have to foreclose." So you're paying the premium for the bank's peace of mind. And this premium isn't cheap. It's typically calculated as a percentage of your total loan amount, usually somewhere between 0.5% and 1.5% per year. Let's make that real. Say you buy a $400,000 house with 5% down. That's a $20,000 down payment and a $380,000 loan. If your PMI rate is 1%, that's $3,800 a year. Divide that by 12, and you're paying an extra $316 every single month. That's $316 that goes straight to the insurance company. It doesn't pay down your loan. It doesn't build your equity. It just vanishes. For many people, that's like having a whole extra car payment for a car you don't even get to drive. Now, the exact rate you pay depends on a couple of things. Your credit score is huge. A higher score means you're seen as less risky, so you get a lower PMI rate. The size of your down payment also matters. Putting down 15% will get you a much better rate than putting down 3%. But no matter the rate, the goal is the same. Eliminate it as quickly as possible. This is not a life sentence. This is a temporary toll you pay for entry into the housing market, and there are 5 clear strategies to stop paying it. The first way is the slow and steady do-nothing method. It's called automatic termination. Thanks to a federal law called the Homeowners Protection Act, your lender is legally required to automatically cancel your PMI on the date your loan balance is scheduled to reach 78% of the original value of your home. The key words there are scheduled and original value. You just keep making your regular monthly payments, and based on your amortization schedule, there will be a specific date years down the road when you cross that 78% threshold. On that date, the PMI is supposed to disappear without you lifting a finger. It's the passive approach. But why be passive when you can be proactive? Strategy number 2 is borrower-requested cancellation. The same law that mandates automatic cancellation at 78% gives you the right to request cancellation once your loan balance hits 80% of the original home value. Now, 78% versus 80% might not sound like a huge difference, but depending on your loan, that 2% gap could represent a year or more of payments. That's potentially thousands of dollars back in your pocket. To do this, you have to be in good standing, no late payments, and you have to put your request in writing to your lender. They can't say no if you meet the criteria. You just have to be the one to start the process. Set a calendar reminder. Track your loan balance. The moment you hit that 80% mark, send the letter. Now let's get to the secret weapon, the supercharged method that can vaporize your PMI years ahead of schedule. Strategy 3 is the appreciation hack. Notice that the first 2 strategies were based on the original value of your home, what you paid for it. But what if your home is now worth way more than what you paid? We saw this happen across the country in 2021 and 2022. People bought a home for $400,000, and 2 years later, it was appraised at $500,000. This changes the entire equation. The number that matters is your loan-to-value ratio, or LTV. Let's go back to that $400,000 house with a $380,000 loan. Your original LTV was 95%. But let's say 2 years have passed. You've paid your loan down a bit, and now you owe $370,000. And in that time, the market has been hot, and your home is now worth $500,000. Your new LTV is no longer based on the old price. It's based on the new one. So you take what you owe $370,000 and divide it by the new current value $500,000. Your new LTV is 74%. You are well below the 80% threshold. You can now contact your lender and tell them you believe you have sufficient equity to remove PMI based on the current market value. They will require you to pay for a new official appraisal to prove it, which might cost you $400 to $600. But think about it. You pay $500 one time to potentially save over $300 every single month. That is one of the best returns on investment you will ever find. If you live in an area where home prices are rising, this is the single fastest way to get rid of PMI. Strategy 4 is a close cousin to the appreciation hack: refinancing. If interest rates have dropped since you bought your house, or if your home's value has shot up, you might be able to refinance your entire mortgage. You'd be getting a brand new loan to pay off the old one. If your new appraisal shows that your loan amount is less than 80% of the home's current value, your new loan will not have PMI. This can be a double win. You get rid of PMI and you might lock in a lower interest rate for the next 30 years. The downside is that refinancing comes with closing costs, just like your original purchase, so you have to do the math to make sure the long-term savings outweigh the short-term costs. Finally, there's strategy number 5, the most straightforward of all: the prepayment push. You can reach the 80% LTV threshold faster simply by paying more than you owe. Every extra dollar you pay towards your loan's principal reduces the balance and gets you closer to the finish line. This could mean making one extra mortgage payment per year, or using the bi-weekly payment method, or just rounding up your payment every month. An extra $100 a month might not feel like much, but it can shave months or even years off your PMI payments and save you thousands in interest over the life of the loan. Now, a critical warning. Everything we just discussed applies to conventional loans. If you have an FHA loan, which is very common for first-time buyers, the rules are different and they are brutal. For most FHA loans taken out after 2013, if you put down less than 10%, you are required to pay their version of mortgage insurance called MIP for the entire life of the loan. It never automatically drops off. It doesn't matter if you have 50% equity. The only way to get rid of it is to refinance out of the FHA loan and into a conventional loan. This is a massive gotcha that traps thousands of homeowners. So if you have an FHA loan, your primary mission is to build equity as fast as you can to prepare for that refinance. So you've conquered PMI, you've planned your attack, and you're saving hundreds every month. But just when you think you've accounted for every dollar, you get to the finish line, the closing table, and get hit with a list of fees you've never even heard of. These are called closing costs, and they can add thousands, even tens of thousands of dollars to the cash you need to buy your home. So what exactly are you paying for? Can any of these fees be negotiated? And what's the one secret document that reveals every single cost before you're legally on the hook? The answer lies in one of the most misunderstood and expensive parts of buying a home: closing costs. Think of them as the final boss battle after you've already fought your way through the entire game. These are the fees you pay to finalize the mortgage and transfer the home's title into your name, and they typically run between 2 and 5% of the home's purchase price. On a $400,000 house, that's anywhere from $8,000 to a staggering $20,000 in cash you need on top of your down payment. So let's pull back the curtain and demystify this giant pile of fees. What are you actually paying for? Broadly, closing costs fall into three main buckets: lender fees, third-party fees, and prepaids. First, the lender fees. This is the money your lender charges for the service of creating your loan. Think of it as their direct paycheck for all the work they've done. You'll see line items like an origination fee, which is basically a commission for the loan officer. You'll see an underwriting fee, which pays the salary of the person who meticulously combed through your financial life to approve you. There might be an application fee, a processing fee, or other administrative sounding charges. Here's the critical takeaway. These are the most negotiable fees on the list. This is the lender's pure profit, and when lenders compete for your business, this is where they have the most wiggle room. We'll come back to exactly how to negotiate these in a minute. Next up, we have third-party fees. These are costs for services performed by other companies, not your lender, that are required to close the deal. Your lender is just coordinating them and passing the bill to you. This includes the appraisal fee, which you already know about. It includes the credit report fee. It includes a flood certification fee to determine if your property is in a flood zone. The biggest one in this category is often title insurance. This is a crucial but confusing cost. You're actually buying two separate policies. The first is a lender's title policy, which is mandatory. It protects the lender in case there's a dispute over who legally owns the property. The second is an owner's title policy, which protects you, the new owner. While technically optional in some cases, you should never, ever skip it. It's your shield against claims from long-lost heirs or forged signatures from decades ago that could threaten your ownership of the house. Other third-party fees might include a survey fee to verify property lines or attorney fees, if you're in a state that requires one to handle the closing. Now, while you can't negotiate the price of the title insurance with your lender, you often have the right to shop around for your own title company, and prices can vary significantly. The third and final bucket is prepaids and escrows. This is where most first-time buyers get completely lost, but it's actually pretty simple when you break it down. These aren't fees for services. This is you pre-funding an account for your future housing expenses. Your lender needs to make sure you'll pay your property taxes and homeowner's insurance on time, because if you don't, they could lose their investment. So, they set up an escrow account. Think of it as a savings account for your house that they manage. At closing, you'll deposit a cushion of money into this account, usually several months' worth of property taxes and homeowner's insurance premiums. Then each month, part of your total mortgage payment will be diverted into this escrow account, and when the tax and insurance bills are due, the lender pays them for you automatically. You'll also have to prepay for a full year of your homeowner's insurance policy upfront, and you'll prepay the interest on your mortgage for the remaining days of the month in which you close. For example, if you close on September 20th, you'll pay for the interest from the 20th to the 30th at the closing table. Okay, that's a ton of different fees and it sounds overwhelming. So how do you keep track of it all? This brings us to that secret document, the single most important piece of paper you'll receive in the early stages of the mortgage process. It's called the loan estimate. This 3-page document is your superpower. By federal law, a lender must send you a standardized loan estimate within 3 business days of you submitting a mortgage application. This form lays out, in black and white, every single estimated cost associated with the loan. It's designed to be easy to read and, most importantly, easy to compare. This is your secret weapon for negotiation. You should apply with at least 3 different lenders, get 3 different loan estimates, and compare them line by line. On page 1, you'll see the big picture numbers: the loan amount, the interest rate, your estimated monthly payment including taxes and insurance, and your estimated cash to close. But the real magic happens on page 2. This is the detailed breakdown of all those closing costs we just talked about. It's organized into sections. Section A, origination charges, is the lender's direct fees. This is your primary negotiation target. If lender A is charging a $1,500 origination fee and lender B is charging $500, you have a powerful piece of leverage. You can go back to lender A and say, "I have a competing offer with much lower fees. Can you match this?" More often than not, they will. Section B lists services you can't shop for, like the appraisal and credit report. Section C lists services you can shop for, like title insurance, the survey, and pest inspection. The loan estimate will literally tell you, you can shop for this service, and provide a list of providers if the lender has a relationship with any. This is your invitation to do some homework and potentially save hundreds of dollars. The rest of the page details the prepaids, the initial escrow deposit, and other costs. The beauty of the loan estimate is that it locks the lender in. The fees in Section A cannot change at closing, period. The third-party fees have a limited tolerance, meaning they can only increase by a certain small percentage. This prevents a bait and switch, where a lender quotes you low fees up front and then jacks them up at the last minute. Once you've used your loan estimates to negotiate the best deal and you move forward with a lender, you'll get one final, even more important document right before closing. It's called the closing disclosure. You must receive this document at least 3 full business days before your scheduled closing date. This is not a suggestion. It's the law, designed to give you time to review everything without pressure. The closing disclosure looks very similar to the loan estimate, and that's by design. Your job is to sit down with both documents, side by side, and compare every single number. They should be nearly identical. If the loan amount is different, if the interest rate changed, if a fee in Section A suddenly appeared or increased, that is a massive red flag. You need to call your loan officer immediately and ask, "Why is this different?" Don't be shy, don't be intimidated. This is your money and your future. Legitimate changes can happen. For example, if you decided to lock your interest rate late in the process, but the lender must be able to provide a clear and valid reason for every single discrepancy. So, to recap the strategy for conquering closing costs: first, get multiple loan estimates from different lenders. Second, compare them line by line, focusing on the interest rate and the fees in Section A. Third, use a better offer to negotiate with your preferred lender. Fourth, shop around for the services in Section C, especially title insurance. And finally, when you receive your closing disclosure, check it against your loan estimate with a fine-tooth comb to ensure there are no last-minute surprises. By understanding what you're paying for and using these 2 critical documents as your guide, you transform from a passive participant into an empowered consumer. You can save yourself thousands of dollars and walk into your closing day with absolute confidence, knowing you got the best deal possible. But that brings us to the day itself. You've done all the hard work, you've checked the numbers, and now you're sitting at a table with a mountain of paperwork in front of you. What exactly happens in that room? Who's there? And what are the critical things you need to do before you sign on that final dotted line? And more importantly, what happens the day after you get the keys? What are the biggest financial traps that new homeowners fall into in their first year that can cost them their dream? We're going to break down closing day and your first year of homeownership next. Alright, let's talk about the final boss battle of buying a home. Closing day. This is the culmination of everything. The stress, the paperwork, the waiting. It all comes down to a few hours in a conference room with a mountain of documents. But before you even get to that room, you have one last critical mission: the final walkthrough. Do not skip this. I repeat, do not skip the final walkthrough. This is your last chance to ensure the house is in the condition you agreed upon. The sellers are moved out, the place is empty. And this is when you might notice the giant hole in the wall that was hiding behind their family portrait, or discover that they took the custom chandelier that was supposed to stay. You need to verify that all agreed upon repairs have been completed, and that no new damage has occurred during the move out. Turn on every faucet, flush every toilet, flick every light switch. Test the appliances. If something is wrong, you address it before you sign the papers, not after. Once you sign, that problem is officially your problem. Okay, you've done the walkthrough and everything looks good. Now you head to the closing table. What do you need to bring? 2 main things: a government-issued photo ID, and a cashier's check for your closing costs and down payment. Your lender or closing agent will have given you the exact, down-to-the-penny amount a few days prior. This isn't the time for a personal check. It has to be certified funds. You'll walk into a room, likely with your real estate agent, a closing agent or attorney, and maybe the sellers and their agent. The star of the show here is a document called the Closing Disclosure, or CD. You should have received a copy of this at least 3 business days before closing. This document is your financial Bible for the transaction. It itemizes every single fee, every credit, every dollar changing hands. Your job, right there at the table, is to compare it to the loan estimate you received at the very beginning of this process. They should be remarkably similar. If you see a new mysterious fee or a number that's drastically different, you stop the presses. You ask, "What is this?" You do not sign until you get a satisfactory answer. This is your money, and this is your last chance to protect it. Then comes the signing. And I mean the signing. You are going to sign your name so many times your hand will feel like it's going to fall off. You'll sign the mortgage note, which is your promise to repay the loan. You'll sign the deed of trust, which gives the lender the right to foreclose if you don't pay. You'll sign dozens of other disclosures and affidavits. It can feel overwhelming, like you're just initialing page after page without a clue. But take a breath. Ask the closing agent to briefly explain any document you're unsure about. That's what they're there for. And then, after the last signature, after the checks are exchanged, it happens. The closing agent slides a set of keys across the table. They're yours. That's it. You did it. You own a home. The feeling is indescribable. It's a mix of terror and pure exhilaration. You'll probably drive to the house and just stand in the empty living room, letting it all sink in. The click of your key in your own lock for the very first time is a sound you will never forget. But this is where our real conversation begins. Because the single biggest mistake first-time homebuyers make is thinking that the hard part is over. In reality, the financial marathon has just begun. And the first year is littered with traps that can turn your dream home into a financial nightmare. The first and most dangerous trap is becoming house poor. You've heard the term, but what does it really mean? It means you can technically afford your mortgage payment, your pity, but you have nothing left over. You're eating ramen noodles in a 4-bedroom colonial. Every dollar that comes in goes right back out to the house. This happens because people budget for the mortgage, but they drastically underestimate the total cost of ownership. Your electric bill in a 2,000 square foot house is not the same as it was in your 700 square foot apartment. The water bill, the gas bill, the trash collection, it all adds up. And then there's the big one, maintenance. That leaky faucet isn't your landlord's problem anymore. That weird noise the furnace is making? That's on you. The lawn that needs mowing, the gutters that need cleaning, the deck that needs restaining. It's a constant, never-ending list. Here is the single most valuable piece of advice for your first year. Budget, at a minimum, 1% of your home's purchase price for annual maintenance and repairs. If you bought a $400,000 house, that is $4,000 per year, or about $333 a month that you need to be setting aside into a separate savings account. This is your home emergency fund. When the water heater inevitably dies on a cold Saturday morning, you won't have to put it on a high-interest credit card. You'll be prepared. The 1% rule isn't a suggestion, it's a survival guide. The second trap is the immediate renovation frenzy. You close on Friday, and by Saturday morning you're at Home Depot with a cart full of paint, flooring, and light fixtures, ready to make all your Pinterest dreams come true. You want to tear down that wall, gut that dated bathroom, and install the kitchen island you've always wanted. I get it. The temptation is immense. But this is a classic rookie mistake. You have just drained your savings for the down payment and closing costs. Your financial reserves are at their lowest point. The last thing you should do is rack up thousands in credit card debt for cosmetic upgrades. Live in the house for at least 6 months. A year is even better. Learn its personality. Understand the flow of the rooms. Figure out what truly bothers you and what you can live with. That weird layout you hated might actually be brilliant once you've lived with it. That kitchen you wanted to demolish might just need a coat of paint on the cabinets. Living in the space gives you clarity. It allows you to differentiate between a want and a need. And it gives you time to rebuild your savings so you can pay for those renovations with cash, not debt. Trap number 3 is the escrow surprise party. And trust me, it's not a fun one. When you pay your mortgage each month, part of that payment goes into an escrow account to cover your property taxes and homeowner's insurance. The lender manages it for you. Feels simple, set and forget it. But it's not. At least once a year, your lender will do an escrow analysis. They'll look at what they paid for your taxes and insurance versus what you contributed. And guess what? Taxes and insurance almost always go up. Property values in your area rise, so your tax assessment goes up. The cost to rebuild your home increases, so your insurance premium goes up. When the lender sees this, they find a shortfall in your escrow account. They have to make up that difference, and they have to adjust your future payments to collect enough for next year's higher bills. The result? You get a letter in the mail saying your mortgage payment is jumping up by even $300 a month, effective immediately. It's a gut punch. To avoid this shock, you have to be proactive. Pay attention to your local property tax assessments. When your homeowner's insurance policy is up for renewal, shop around for better rates. Assume your payment will go up each year and budget for it, so when that letter arrives, you're prepared, not panicked. Finally, the 4th trap is one of omission. Failing to file for your homestead exemption. This is one of the easiest, most overlooked ways to save a significant amount of money. In most states, a homestead exemption is a tax break that can reduce the taxable value of your primary residence. This, in turn, lowers your annual property tax bill. But here's the catch. It is not automatic. You have to apply for it, and there are deadlines. The moment you close on your home, one of your first tasks should be to Google your county name plus the words homestead exemption. Find the form on your local property appraiser's website, fill it out, and submit it. It might save you hundreds or even thousands of dollars every single year. Not doing this is literally throwing money away. Surviving that first year is about shifting your mindset from renter to owner. It's about planning for the unexpected, delaying gratification on cosmetic wants, and proactively managing the hidden costs of your home. You've won the battle of buying the house. Now you have to win the war of owning it. But what about the long game? How do you turn this massive liability into your single greatest asset? How do you build equity faster? Know when it's the right time to refinance, and use your home to build true generational wealth. That's the ultimate goal, and that's exactly what we're covering in our final part. Let's start with the most direct way to attack your mortgage and build equity at lightning speed. Extra payments. When you make your standard monthly mortgage payment, a huge chunk of it in the early years goes straight to interest, not to paying down your actual loan balance. Think of it as a race against interest. The faster you pay down the principal, the actual amount you borrowed, the less interest you'll pay over the life of the loan. The simplest strategy is the bi-weekly payment plan. Instead of making one monthly payment, you make a half payment every 2 weeks. Because there are 52 weeks in a year, this results in 26 half payments, which equals 13 full monthly payments. That one extra payment per year, without you even feeling it, can shave 4 to 8 years off a 30-year mortgage and save you tens of thousands of dollars in interest. Many lenders offer this as an automated service, but you can do it yourself for free. Just take your monthly payment, divide it by 12, and add that amount to your payment each month. Another powerful method is making a single, lump sum payment toward your principal whenever you can. Get a bonus at work? A tax refund? Instead of buying a new TV, consider putting that $1,000 or $2,000 directly toward your principal. Make sure you explicitly tell your lender that the extra funds are for principal reduction only. Otherwise, they might just apply it to your next month's payment. Every dollar you pay down on your principal is a dollar that interest can no longer be charged on forever. It's a guaranteed return on your investment. Beyond payments, you can actively increase your home's value through smart renovations. This is called forced appreciation. We're not talking about putting in a swimming pool or a home theater. We're talking about strategic upgrades with a high return on investment. Kitchen and bathroom remodels consistently top the list. Updating countertops, cabinets, and appliances can dramatically increase your home's appraised value. Other high ROI projects include finishing a basement, adding a deck, or improving curb appeal with new siding or landscaping. The key is to think like an appraiser, not just a homeowner. Every dollar you invest in these projects can translate into several dollars of new equity. Now let's talk about a game-changing financial tool: refinancing. Simply put, refinancing is taking out a new loan to pay off your existing mortgage. The new loan ideally has better terms. The number one reason people refinance is to get a lower interest rate. If rates have dropped significantly since you bought your home, you could lower your monthly payment and save a fortune over the long run. The old rule of thumb was to consider refinancing if you could lower your rate by at least 1%. But today, even a 0.5% drop can be worthwhile, depending on your loan size. But it's not just about the rate. You can also refinance to change your loan term. Maybe you're 5 years into a 30-year mortgage, your income has increased, and you want to pay off your house faster. You could refinance into a 15-year mortgage. Yes, your monthly payment will go up, but the interest rate on a 15-year loan is almost always lower than a 30-year, and you'll be debt-free decades sooner, saving an astronomical amount in interest. Another huge reason to refinance is to get rid of private mortgage insurance, or PMI. Remember that pesky extra fee you have to pay if your down payment was less than 20%? Once your home's value has increased and you have at least 20% equity, you can refinance into a new loan that doesn't require PMI, potentially saving you hundreds of dollars every single month. But here's the critical part: refinancing isn't free. You'll have to pay closing costs just like you did when you first bought the house. These can be anywhere from 2% to 5% of the new loan amount, so you have to do the math. You need to calculate your break-even point. It's simple. Take the total closing costs and divide them by your monthly savings. For example, if your closing costs are $6,000 and your new, refinanced mortgage saves you $250 a month, your break-even point is 24 months. If you plan on staying in that house for more than 2 years, refinancing is a fantastic financial move. If you think you might move sooner, it's probably not worth it. This brings us to the ultimate wealth-building strategy: using your home as a financial engine. Your home equity is not just a number on a piece of paper. It's a powerful financial asset you can leverage. The most common way to do this is through a cash-out refinance. This is where you refinance your mortgage for more than what you currently owe and take the difference in cash. Let's say your home is worth $400,000 and you owe $200,000 on your mortgage. You have $200,000 in equity. A lender might allow you to borrow up to 80% of your home's value, which is $320,000. So, you could take out a new $320,000 mortgage, use $200,000 to pay off the old loan, and walk away with $120,000 in cash. Now, this is where discipline becomes paramount. This cash is not for a fancy vacation or a new car. That's how you turn a valuable asset into a dangerous liability. The goal is to use that money to buy another asset that generates income or appreciates in value. You could use that $120,000 as a down payment on a rental property. Now, your primary home has helped you buy a second property that a tenant is paying for, while both properties continue to appreciate in value. This is the foundation of real estate wealth. You could use the cash to start a business, invest in the stock market, or pay for a degree that will significantly increase your earning potential. You are using debt that is secured by a stable asset to acquire more assets. Another option is a home equity line of credit, or a HELOC. Think of it like a credit card that's secured by your house. Instead of getting a lump sum of cash, you get a revolving line of credit that you can draw from as needed. This offers more flexibility, and you only pay interest on the money you actually use. It's a great tool for home renovations or for having a large emergency fund on standby. You started this journey with questions about down payments, credit scores, and interest rates. Now you're equipped with the knowledge to think about equity, leverage, assets, and generational wealth. You've gone from a potential homebuyer to a potential investor. You now understand that a mortgage isn't just a bill you have to pay for 30 years. It's a tool. It's a mechanism for converting your monthly housing expense into a powerful wealth-building machine. Your home is more than just 4 walls and a roof. It's the launchpad for your financial future. This 10-part journey was designed to give you clarity and confidence, to demystify the most complex financial decision of your life, and turn fear into empowerment. The American dream of homeownership is alive and well, but it has evolved. It's no longer just about having a place to call your own. It's about financial freedom. It's about building a legacy. If this series has helped you take one step closer to that dream, If it's given you the confidence to pick up the phone and call a lender, then we've succeeded. The path won't always be easy, but it is achievable. And now you have the map. You have the answers. For everyone who made it to the very end of this masterclass, thank you. The knowledge you've gained puts you ahead of 99% of first-time homebuyers. Share this series with one person you know who is about to start their own journey. Give them the gift of confidence that you now have. Your home is waiting. Go build your future.